All right, let's jump right in. We're going to build the bridge from the profit you see on paper to the actual real cash in the bank. Have you ever wondered how a company can announce these record-breaking profits but somehow still be struggling for cash? Well, we're about to figure out exactly why that happens. Okay, so here's our game plan. First, we'll compare the two big methods for cash flow, direct and indirect. Then we'll get into the weeds on that huge difference between profit and cash. After that, we'll break down the key working capital ratios, the real drivers of cash flow. We'll even walk through a forecast to see it all in action and tie it together with something called the cash conversion cycle. And finally, we'll wrap up with some common traps so you can steer clear of them. So you're probably already familiar with the direct method of cash flow. It's great, right? Super simple, very intuitive. It's fantastic for looking back at what already happened. But when we need to look forward, when we need to forecast, we really need a more powerful tool. And that's where the indirect method comes in. Let's dig into why it's so essential for forecasting. Here's the key difference, and it's a big one. The direct method, it's like a checkbook register. It just tells you what happened to your cash. But the indirect method, well, it's more like a detective. It starts with your profit and tells you why your cash changed. It connects the dots between your operations and your bank account. And that connection, that's the secret to building a really powerful forecast. Okay, let's build that bridge. You see, the whole world of accounting operates on what's called the accrual basis. That just means a company records a sale as soon as they earn it, even if the customer hasn't actually paid them a dime yet. This creates this natural gap between the profit on paper and the cash in reality. The indirect method is the tool we use to close that gap. The whole thing is really just a logical three-step process. First, you grab your net income. Easy enough. Second, you add back any expenses that weren't actually cash, like depreciation. It lowered your profit, but no cash actually left the building. And third, and this is the really crucial part, you adjust for changes in your working capital. This is all the money tied up with customers who haven't paid yet or in inventory sitting on a shelf. This quote just nails it, doesn't it? It perfectly illustrates the puzzle we're trying to solve. The income statement, the balance sheet, and the cash flow statement. They all tell one connected story. The indirect method is the key that unlocks that story. It explains that critical timing gap between earning a dollar and actually having that dollar to spend. So, to make those working capital adjustments and make them accurately, we've got to master the three main levers that treasury managers are pulling and pushing every single day. They are DSO, DIO, and DPO. And trust me, these aren't just boring metrics. They are your command dials for managing cash. Before we even look at a formula, let's just think about this intuitively. DSO, or Days Sales Outstanding, it's just how long you have to wait to get paid. That's it. If you have a high DSO, you're basically acting like a bank for your customers. A lower DSO means you're getting your cash a whole lot faster. Now, this is where the forecasting magic happens. We can actually flip the standard DSO formula around. So instead of using our sales to calculate our DSO, we can use a target DSO, say 60 days, to forecast what our accounts receivable balance is going to be. This is how you link an operational goal directly to a number on your future balance sheet. It's pretty cool. Okay, next up is DIO, Days Inventory Outstanding. This one tells us how long our cash is literally tied up in boxes sitting on a shelf or in a warehouse. Every single day that inventory just sits there, it's capital that we can't use for anything else. And you guessed it, just like with DSO, we can use our target DIO and our forecasted cost of goods sold to project the dollar value of inventory we'll need. It's a direct link between how fast we move product and what our balance sheet looks like. And finally, we have DPO, or Days Payable Outstanding. This is the other side of the coin. It measures how long we get to use our suppliers' money before we have to pay our own bills. So, a higher DPO means we're effectively getting a short-term interest-free loan from our suppliers, which is pretty handy. And with this formula, we can project our future accounts payable balance. This is a super powerful tool because it quantifies exactly how much financing we're getting from our suppliers. And that's a really critical source of cash for day-to-day operations. Okay, theory is great, but let's make this real. Let's actually walk through a simple 2-month forecast. We'll see exactly how these ratios all fit together to build our cash flow projection. So here are our assumptions. We've got a company, and its sales and costs are growing. But its working capital efficiency, the DSO, DIO, and DPO, is staying exactly the same. This is a super common scenario for any growing business.
Okay, so now we just plug our assumptions into those formulas we just learned, and look what happens. Even though our ratios, like our 60-day DSO, stayed constant, our actual dollar balances did not. Because our revenue and costs are growing, the amount of money in accounts receivable, inventory, and accounts payable all go up from month 1 to month 2.
So let's just pause here for a second and think about this. We're growing, sales are up, our accounts receivable is higher. I mean, that sounds great, right? But what did that growth actually do to our cash in the bank?
And this slide right here, this reveals the whole puzzle. An increase in an asset, like accounts receivable or inventory, is a use of cash. Think of it this way. Money that your customers still owe you isn't in your bank account yet. On the flip side, an increase in a liability, like accounts payable, is a source of cash because you're holding onto your money just a little bit longer. So here, even though sales were growing, the net effect was that growth actually sucked up over $44,000 in cash.
All right, let's zoom out for a second. How do managers and executives keep track of all these moving parts at a high level? Well, they use a single, really powerful metric called the cash conversion cycle. You can think of it as the ultimate dashboard for your company's operational efficiency. The CCC tells you in days how long your cash is locked up in the business. That's it. So the goal of pretty much every treasury team on the planet is to make this cycle shorter, collect from customers faster, hold less inventory, and maybe pay your own suppliers just a little bit slower. It is the purest measure of capital efficiency. Before we finish up, I really want to call out a few common traps. Seriously, getting these wrong can completely torpedo your forecast. So let's make sure you know exactly what to watch out for. This is, without a doubt, the number one mistake people make. Your ratios, like a 60-day DSO, they're based on a 365-day year. So if your forecast is using monthly revenue, you can't just plug that number in. You have to multiply it by 12 first to get an annualized number. You have to compare apples to apples. An annual ratio needs annual data. And definitely watch out for these other pitfalls. Remember, it is not the final balance of AR that hits your cash flow. It's the change, the delta, from one period to the next. And look, if you don't remember anything else, burn this into your brain. When an asset goes up, your cash goes down. When a liability goes up, your cash goes up. So, what's the one big thing to take away from all this? I think this quote says it perfectly. You can be the most profitable company in the world on paper, but if your growth starts to outpace your ability to fund your working capital, you can literally run out of cash. Managing that balance, that is the absolute essence of financial strategy.